So to really understand the sheer scale of what just happened in the global financial markets today, I mean, we need to look backward for just a second.
Right, yeah, historical context is huge here.
Exactly. Like if you were investing back in the mid-2000s, you probably remember when the search engine Baidu went public in 2005.
Oh, yeah, the massive first-day pop.
Right. It logged this insane first-day gain of 354%. And for a long time, that stood as like the absolute high watermark for that kind of debut. It was the biggest first-day jump of its decade.
Which was a massive deal at the time.
Yeah, completely. But today, July 27, 2026, a company called Changjin Memory Technologies, or CXMT, just went public on the Shanghai Stock Exchange. And their shares soared roughly 500% intraday.
Yeah, I think it was around 470% depending on the exact intraday timing, but yeah, nearly 500.
Which is just mind-blowing.
It really is. And the numbers we were looking at with CXMT, they just completely redefined market expectations. I mean, they raised 66.6 billion yuan.
So that's roughly, what, 9.8 billion US dollars?
Exactly, making it the largest IPO in Asia this year. But the valuation is what is truly arresting here. At the peak of trading today, the market capitalization hit an estimated 3.3 to 3.65 trillion yuan.
So around half a trillion US dollars.
Yes, half a trillion. Meaning, in a single trading session, a 10-year-old chip maker just dethroned the Industrial and Commercial Bank of China to become the country's most valuable listed company.
Okay, let's unpack this, because I'm sure you listening are wondering the exact same thing I am.
Yeah.
How does a company founded just 10 years ago, in 2016, reach $500 billion in value, like completely bypassing all the traditional legacy banking giants?
Well, what's fascinating here is that the valuation isn't just a reflection of their balance sheet. It's a reflection of three converging macroeconomic forces.
Right.
First, you have the structural shift driven by AI. Second, there's a severe global shortage in memory manufacturing capacity. And third, the ongoing technology trade policies between the U.S. and China.
Yeah, the geopolitical tech war, essentially.
Right. So you have the U.S. implementing these comprehensive export controls targeting advanced semiconductor equipment. They are seeking to limit China's capacity in high-end chip making.
Which we've seen escalating over the last few years.
Exactly. And in parallel, China is executing this heavily funded national mandate to build a completely self-reliant semiconductor ecosystem. So CXMT is really the physical manifestation of that domestic policy.
But here's the thing. That national mandate provides the capital, sure, but you still need the actual foundational technology. I mean, you can't just mandate intellectual property into existence.
No, you absolutely cannot.
And based on the semi-analysis reports we combed through for this deep dive, CXMT didn't invent their core architecture in a vacuum. They essentially built this new empire on the blueprints of a dead European company.
Yeah, the Kaimonda legacy. The origins of this go back to the founder, Zhu Yiming. He'd already built a successful semiconductor firm called GigaDevice, but his real ambition was to crack into the DRAM market, dynamic random access memory.
Which is incredibly hard to break into, right?
Oh, incredibly. The barrier to entry in DRAM isn't just, manufacturing capability. It is a legal fortress.
Because of the patents.
Exactly. The market is dominated by Samsung, SK Hynix, and Micron, and they hold decades of overlapping patents. If a new player tries to develop DRAM organically from scratch,
they just get sued into oblivion.
Basically, yeah. They will inevitably infringe on existing IP and face immediate litigation.
So you have to find a backdoor into the IP. And Zhu found his through a German company called Kaimonda, which had gone bankrupt all the way back in 2009.
Precisely. Kaimonda was defunct, right? They were dead.
Right.
But their intellectual property portfolio was still legally intact. So through a partnership with the Hefei municipal government, CXMT bought up approximately 7,000 patents.
Wow.
And get this, 2.8 terabytes of technical documentation from the Kaimonda estate.
It's like buying the blueprints of an abandoned skyscraper.
That's a great way to put it.
But blueprints from 2009 are basically ancient history in semiconductor years, right? I mean, how do you even use that?
Well, to make them viable, CXMT recruited the very engineers who originally wrote those documents. They brought them out of retirement, basically.
Wait, really? The original German engineers?
Yeah, including a highly respected industry veteran named Karl-Heinz Kusters. They needed the institutional memory of these specific engineers to modernize Kaimonda's unique approach, which was called the buried word line architecture.
Okay, let's get into the mechanics of that for a second. Because the standard approach to memory at the time was building the electrical gates horizontally across the surface of the silicon wafer.
Right, laying them out flat.
Yeah, but as you shrink transistors to fit more memory on a chip, those horizontal gates start interfering with each other. You get electrical crosstalk.
Exactly.
So buried word line solves this by physically digging a microscopic trench into the silicon and burying the gate vertically inside the wafer.
It's brilliant. It prevents signal leakage and saves all that premium surface area.
It's like building underground parking instead of a giant surface lot.
Yes. And that vertical integration was Qimonda's competitive edge before the 2008 financial crisis wiped out their capital.
So they just ran out of money before they could really capitalize on it.
Exactly. And CXMT recognized that if they could take that 2009 trench architecture, update it with 2016 material science, and use modern lithography, they could bypass the patent fortress of Samsung and Micron entirely.
Because it's a completely different foundational architecture.
Right. But executing that modernization required a staggering amount of upfront capital and, honestly, an incredibly high tolerance for failure.
Which brings us to the financial engine of this entire operation, the Hefei municipal government. Because in the West, we're so used to the Silicon Valley venture capital model.
Oh, yeah, where funds demand a return on investment within a 5 to 7 year window.
Exactly. If a startup doesn't show a clear path to profitability quickly, the funding just gets cut. You're done. But Hefei operated on a totally different paradigm.
Yeah, they function as a form of state-backed, highly patient capital. Over nearly 10 years, the Hefei government and associated state funds absorbed a cumulative loss of 36.65 billion RMB funding CXMT.
36 billion.
Yeah, they didn't see a single year of full profitability until 2025.
That is just wild to think about.
And their investment wasn't just cash injections for research and development. They physically engineered an entire ecosystem.
Right, the supply chain.
Yeah, the municipal government brought in packaging and testing firms like Peidoon and industrial gas suppliers like Guanggang Gas, and they built their facilities directly adjacent to the CXMT fabrication plants.
So basically anchoring the supply chain right to the factory walls.
Exactly. Which eliminates transit delays, lets them co-develop integration processes, and protects the company from external supply shocks.
I want you listening to just imagine this for a second. Imagine running a business that burns billions of dollars for 9 straight years.
Yeah.
In most global markets, a board of directors pulls the plug after year 3.
Oh, absolutely.
But here, your primary investor just keeps building roads and power grids and adjacent factories around your losses because the long-term strategic goal of sovereign technology infrastructure is just more important than short-term profit.
And that structural patience is exactly what allowed CXMT to survive long enough to meet a market that was perfectly primed for their product.
The timing is crazy.
It really is. By the time they finally perfected the modernized buried word line architecture and scaled up their yield, the global semiconductor market was entering an unprecedented supply crunch.
Which brings us to 2026. Because the financials from late 2025 into 2026, they document a violent shift in their reality.
The profit explosion.
Yeah, we looked at the KR Asia data and the semi-analysis stuff, and after finally scraping that first profit in 2025, their Q1 2026 revenue exploded to $7.3 billion.
Which is a 700% year-over-year increase.
700%. And their net profit surged 1,688%, driving operating margins to 70%.
It's staggering.
But, this naturally invites a healthy dose of skepticism.
Yeah.
Because are their chips really that revolutionary, or are they just riding an AI hype bubble?
It's a fair question.
Right, because a company holding roughly a 9% share of the global DRAM market is now trading at nearly 300 times its 2025 earnings. How does a 9% market share justify a 700% revenue spike in 12 months?
Well, if we connect this to the bigger picture, the justification lies in the mechanics of the current DRAM supercycle.
Okay, break that down for us.
So CXMT's explosive growth is not a result of them displacing Samsung or Micron and stealing massive market share.
Right.
It is a result of those legacy giants pivoting their fabrication capacity away from standard commodity memory. They're focusing almost exclusively on high-margin chips for AI data centers.
Because AI is where the absolute top-tier money is right now.
Exactly. And because the major players basically abandoned the traditional consumer electronics memory market, a massive supply vacuum opened up.
So suddenly, all the device manufacturers building standard laptops, smartphones, automotive systems,
they suddenly couldn't source memory. They were starved for it. And consequently, the average selling price, or ASP, for standard DRAM skyrocketed.
wow.
Yeah, CXMT's ASP jumped 57% in just the first quarter of 2026, simply because they had inventory in a market that desperately needed it.
Which, this actually directly contradicts a long-held assumption in the tech world. Like, the prevailing theory for years was that the moment Chinese fabrication plants reach scale, they would heavily subsidize their chips, undercut global pricing, and basically flood the market with cheap memory.
Right, the whole race to the bottom theory.
Yeah, the fear that they'd destroy the profit margins of their Western and South Korean competitors.
But the semi-analysis data explicitly refutes that. It's a total myth in this case. CXMT is operating as a highly rational commercial actor.
Because they aren't dropping prices.
Exactly. Their current pricing is only 5 to 10% lower than comparable chips from Samsung and Micron. They recognize the severe undersupply in the market, and they are pricing their inventory to capture maximum margin.
Hence that insane 70% operating margin.
Right. They are prioritizing capital accumulation over aggressive market share expansion.
And that strategy catalyzed an immediate macro effect on the domestic financial markets today. I mean, when the CXMT IPO debuted, we saw the large-cap CSI 300 index entirely reverse its early session losses.
Which is incredibly rare for a single stock to do.
Yeah, but when a company debuts with a $500 billion valuation, it instantly becomes a heavily weighted constituent in the major indices. So all these fund managers tracking those indices are forced to buy the stock to maintain their portfolio weightings.
Right. It triggers a scramble to reposition.
Exactly, which creates this massive sudden influx of liquidity that drags the whole broader market upward.
It acts as a structural liquidity event. But, and this is crucial, that $500 billion valuation prices in an assumption of flawless future execution in advanced computing.
Which is far from guaranteed.
Exactly. While CXMT is generating immense cash flow today, their revenue is overwhelmingly concentrated in a legacy technology tier.
And here's where it gets really interesting. Because that concentration is actually their biggest vulnerability. According to the filings, roughly 99% of CXMT's current output is standard commodity DRAM.
DDR, LPDDR chips, yeah.
Right. The stuff powering standard consumer devices. What they were severely struggling to produce at scale is high bandwidth memory, or HBM.
And HBM is the bottleneck for the entire global AI revolution. Standard DRAM is great, but it processes data in a relatively linear, flat structure.
It's too slow for AI.
Exactly. HBM fundamentally changes the physical architecture of the memory to increase data transfer speeds exponentially. It's what the top-tier AI needs.
To visualize the mechanical challenge of HBM, imagine you were building a house. Standard DRAM is like laying out a sprawling, single-story house. It's pretty easy to build, easy to wire, highly profitable right now.
Right.
HBM requires taking like 8 or 12 of those houses, stacking them directly on top of each other like a delicate house of cards, and then drilling thousands of microscopic elevator shafts straight down through the entire stack to connect them vertically.
That's a perfect analogy. In semiconductor manufacturing, those elevator shafts were called through-silicon vias, or TSVs.
TSVs.
Yeah, and the TSV analogy really highlights the core engineering struggle here. You are drilling microscopic holes through ultra-thin silicon dies and filling them with copper to transmit the electrical signals.
Which sounds incredibly difficult just on its face.
It is, but the main problem is that copper and silicon have different coefficients of thermal expansion.
Oh, meaning they react to heat differently.
Exactly. When the chip heats up during intense AI operation, the copper expands at a different rate than the silicon. This introduces immense thermal stress.
So the whole thing just bends.
Yeah, the silicon warps, the microscopic elevator shafts misalign, and the fragile silicon dies can literally crack under the pressure.
Wow.
Because of these physical realities, Semi-Analysis estimates CXMT's combined yield for HBM3 is currently sitting at a dismal 25%.
25%. That means for every 4 premium AI memory chips they manufacture, 3 of them fail quality control and have to be completely discarded.
Oh.
The cash burn on a 25% yield must be astronomical. But they can't simply, engineer their way out of this with better machinery, can they? Because they are structurally locked out of the most advanced equipment.
Right, and this is where the geopolitical trade policies really constrain their technical roadmap. To achieve the microscopic precision required for next-generation HBM, the industry standard is to use extreme ultraviolet, or EUV, lithography.
The super advanced machines.
Right. They use incredibly short wavelengths of light to carve circuits basically at the atomic level. But due to comprehensive U.S. export controls, CXMT cannot purchase EUV systems.
So they're forced to rely on older tech.
Yeah, older deep ultraviolet or DUV lithography machines. And if you are trying to carve a microscopic circuit with a larger wavelength of light, you have to use a process called multi-patterning.
And multi-patterning means what? Doing it multiple times?
Exactly. You have to expose the same silicon wafer to the light 3 or 4 separate times just to carve a single layer of circuitry. Every time you remove the wafer, reposition it, and expose it again, you introduce the probability of alignment errors.
And when you are stacking 12, memory dies on top of each other.
Right. A single nanometer of misalignment at the base level multiplies as you go up the stack, which just further degrades that 25% yield.
Okay, so the cash burn from those low yields is exactly why they needed the public markets today. I mean, it highlights this massive tension in their business model. Because commercially, CXMT could just abandon HBM entirely.
Absolutely.
They could just continue churning out standard commodity DRAM at a 70% margin and print money indefinitely. But strategically, they don't have that option.
No, they carry a national mandate. Beijing views domestic HBM production as critical infrastructure for sovereign AI capabilities. And this mandate is growing more urgent as U.S. export controls tighten.
Like with the proposed MECH Act.
Exactly. Policy frameworks like the MTCH Act and regulatory actions like the U.S. Department of Defense officially labeling CXMT as a Chinese military company, these are designed to systematically cut China off from global AI chips.
So CXMT is essentially expected to bridge that widening gap regardless of the commercial inefficiencies.
Exactly. They have to figure out HBM, period.
And that strategic clash between commercial reality and geopolitics brings us to the actual architecture of this IPO. Because when you examine how CXMT structured their offering to attract public capital while maintaining that strategic mandate, it is a remarkably complex legal maneuver.
It really is brilliant structuring.
Yeah, the IPO prospectus states CXMT claims 7.14 billion RMB in consolidated net profit for 2025. However, it also clearly notes that only 1.87 billion RMB is actually attributable to the parent company.
Right. And the mechanism enabling that discrepancy is called a concerted action arrangement.
Break that down for us.
Okay, so CXMT, the parent company, only holds about 31% of the actual economic rights in its manufacturing fabs.
But who owns the rest?
The majority of the equity, and therefore the right to the actual profits, is held by various state-backed investment funds and municipal entities, like the Hefei government we talked about earlier.
Wait, if the state is retaining the vast majority of the actual economic rights and the dividend payouts, why would any retail or foreign institutional investor buy into this IPO? Aren't they essentially buying into an entity with heavily diluted profit rights?
They are, but investors are buying into the momentum of the consolidated entity. The concerted action arrangement is a legal contract where those state-backed minority shareholders essentially sign over their proxy voting rights to the CXMT management board.
Ah, I see.
So, while CXMT only owns 31% of the factory's cash flow, they exercise over 73% of the voting control over the factory's operations.
Which changes how it looks on paper.
Exactly. Under standard accounting rules, because they maintain operational control, they are permitted to consolidate the total revenues and total production capacity of all those state-owned fabs onto their main balance sheet.
So it allows the publicly traded entity to project a much larger, more dominant market presence. It creates the illusion of a massive, unified profit.
Exactly. It makes them look huge.
That explains the massive valuation despite the diluted economic rights. But it also adds critical context to a very specific kind of wild line in their prospectus. CXMT officially claims they have no actual controller.
Yeah, this raises an important question, doesn't it?
It does. Given that state-backed funds hold the majority of the economic rights and basically provided a decade of operational runway, claiming there is no controller seems completely counterintuitive.
Well, the declaration serves a dual regulatory purpose. On one front, asserting that there is no actual controller, and presenting this distributed independent management board helps assuage concerns from foreign institutional investors.
Because foreign investors might be wary of direct state intervention in daily corporate governance.
Exactly. They want to see a standard corporate board.
Yeah.
And on the regulatory front, minimizing direct on-paper linkages to state actors creates a buffer against international trade scrutiny.
Oh, for export control optics.
Right. It complicates the legal justification for foreign regulators who might be seeking to apply immediate export restrictions based on state ownership thresholds.
So it is a finely tuned corporate structure designed to navigate both global capital markets and international trade law simultaneously.
Exactly.
And when you look at the shareholder registry, there's another layer to their market strategy that completely insulates them from traditional industry risks. Alibaba is listed as approximately a 4% shareholder in CXMT.
Which is a huge detail. The inclusion of Alibaba in the equity structure is a vital strategic advantage. Alibaba operates one of the most expansive cloud computing infrastructures globally.
And cloud servers require exabytes of memory
Exactly.
because memory bandwidth is the primary bottleneck in modern AI cloud architectures, right? Like the processors are fast enough, but they spend most of their time idling, waiting for data to be pulled from the memory banks.
Right, the AI is only as fast as the memory feeding it. So by bringing Alibaba onto the cap table, CXMT isn't just securing an influx of capital.
They are basically integrating a captive, massive-scale domestic buyer directly into their ecosystem.
Precisely. Unlike a traditional memory manufacturer like SK Hynix, which must constantly negotiate contracts, forecast demand, and weather the brutal cyclical downturns of the global memory market.
CXMT has guaranteed built-in demand.
Exactly. Furthermore, the equity partnership facilitates co-engineering. Alibaba can provide CXMT with real-time telemetry data and performance metrics from their cloud workloads.
Which allows CXMT to optimize their future chip designs specifically for Alibaba's servers.
Right, it's a closed-loop ecosystem.
It really is. So when you pull back and look at the entirety of what we have covered today, the trajectory is just staggering. We're analyzing a company that took 2.8 terabytes of architectural blueprints from a defunct German firm back in 2016. They paired that legacy IP with a municipal government willing to absorb 36 billion RMB in losses over 10 years just to build out a localized supply chain. They integrated a premier domestic cloud provider into their ownership structure to guarantee demand, and they launched an IPO precisely as a global AI supercycle decimated legacy memory supply.
It's the perfect storm.
And the culmination of all those factors is a $500 billion valuation today. It forces us to completely reevaluate how competitive leverage is built in the modern semiconductor industry. It is basically a masterclass in combining infinite capital patience with a structurally captive market. So what does this all mean?
Well, I think the most profound implication of today's IPO extends beyond just the semiconductor sector.
How so?
It demonstrates how patient, strategically aligned state capital can take the discarded intellectual property of a bankrupt Western enterprise and, over a decade, incubate it into an entity capable of challenging established global monopolies.
Right.
As the demand for advanced computing accelerates and supply chains fracture along geopolitical lines, it prompts a really important consideration for everyone watching this space. What other abandoned patents or forgotten research from defunct commercial enterprises are currently being quietly funded and modernized in tech hubs around the world, just waiting for the right macroeconomic decade to bloom?
Wow. It fundamentally changes how you view corporate failure, doesn't it? The engineers at Qimonda didn't fail to design a revolutionary memory architecture back in 2009. They simply ran out of capital before the global market evolved to a point where that architecture was necessary.
Exactly.
It just took a decade of patience and a completely different hemisphere for their blueprints to finally build a $500 billion reality. So keep an eye on those discarded ideas. They might just be the foundation of the next massive market shift.